Hello and thanks for checking out ChartGuys.com. We're proud to be one of the most successful technical analysis communities online, teaching you the skills to become a more confident, effective, and informed trader. Join our community of hundreds of analysts worldwide working together to learn the charts, generate profit, and achieve financial independence. For access to daily live chart analysis and market coverage, a thriving chat community, along with dozens of hours of exclusive educational materials. We look forward to seeing you. Let's check out some charts. Hey everyone, checking in on commodities. We'll start on the weekly time frames and then zoom into the daily. Starting it off with the dollar, we still have this rounded looking top here, and we've started to pull back, breaking some of our support levels. The bulls attempted to look like they were trying to shift momentum here towards the middle of the week, but then by the end of the week still ended up with a red candlestick. We can see support 95.68 back from early November, and 95.65 currently held this week. If those levels break, the next level down is 94.79 that we're going to be looking at. But as of right now, the bulls are holding this little base of support in the 95.60s. So the daily time frame, the most important thing for me is the lower high pattern on this pullback. We got the lower highs at 97.71, 97.12, and now 96.96. So on any bounce attempt this coming week, anything under 96.96 is just a daily lower high, and it looks like we're going to potentially see a tightening range between the 95.65 current bottom of this consolidation and the 96.96 top of the most recent bounce. Just over a 1% range to be watching on the dollar. Again, it's important to be watching the dollar regardless of what commodity you are trading because of the general inverse correlation that these commodities have to the dollar. And if I had to rank the strength of that inverse correlation, I would say that gold is the most dependent on the dollar with the inverse relationship. I would say oil is number 2 and natural gas is number 3. And that's just through observations of watching how they all respond to what the dollar is doing. So if you are bullish any of those commodities, specifically gold, you want to see the dollar break this 95.65 support and continue the daily lower high and lower low pattern. Looking at gold on the weekly time frame, bit of an upper wick of profit taking. We got the bullish cross of the 12 and 26 exponential moving averages. And looking back historically, we've seen some decent signals of these crosses because they don't happen very often. And just looking back to 2016, we had 2 bull crosses. This is the third bull cross since 2016. So third cross in 2 years. And as far as bear crosses go, we pretty much only had 2 clear bear crosses. So 5 total crosses in 2 years, and that certainly stands out to me as notable. And whenever I'm looking at previous history of indicators, if it's, not a clear signal, if we were to see these exponential moving averages with bull cross, then right into a bear cross and not a lot of follow through on those signals, then I would disregard it and not pay any attention. But because we don't have that and because it's fairly infrequent, it's more of an important piece of the puzzle to be looking at for me. So we are due for some weekly consolidation. The last higher low was down at 12.11, and we pretty much ran $99 or $89 from that last weekly consolidation. So anything on the weekly above 12.11 is a higher low. So we know that the next time that we consolidate on the weekly chart, a higher low is going to very likely form. And the bulls would love to maintain these exponential supports. You can see they acted as resistance. They then acted as support. And on any other pullback, the bulls want to continue to see those act as support so they can continue to follow through after their bull cross has occurred. So with this upper wick, it's a bearish reversal candlestick, but we always want to look in at more details. And the number one detail that I want to know is, does the shorter term time frame of the daily time frame, has that lost the uptrend yet? And the answer is no. So I take that bearish reversal candlestick on the weekly with a grain of salt because the details are showing me that the uptrend on the shorter term time frames has not been lost and we're just seeing healthy consolidation. Right now, the first support level is 1276.53. It would be fantastic if the bulls could hold that level, but it's not a must hold level by any means because just like the weekly chart has not consolidated for a higher low in a while, the daily chart has not as well. The last little consolidation base was 1241. Now the bulls are consolidating a bit in the 1270s, but even if that level breaks, we could still look to form a higher low anywhere above 1241 and still be looking pretty good overall. So again, the exponential moving averages on the daily time frame, a little bit less smooth, a little bit more fake outs. So that's why the weekly time frame is more important for me. But we did get that bull cross a long time ago back in the low 1200s, and it certainly had some solid follow through since then. So short term key support 1276.53, but otherwise pretty much the daily and weekly uptrend is not in jeopardy of being lost anytime in the near term. the miners had been lagging gold a little bit. So we look at the gold weekly time frame, and we had some very bullish weeks in a row here. And we look at the miners, and it wasn't as bullish. We had upper wicks. But this is, again, another one of those scenarios where you have to look at the details, because these were upper wicks showing profit taking. They are bearish reversal candlesticks on the weekly time frame, yet we did not follow through with them in any way. So if you're only looking on this weekly time frame, you're saying, well, these candlesticks don't work. They're not following through. The signals aren't giving us any kind of insight. But you have to zoom in for more details and see that we never lost this uptrend after the big day that we had on December 19th. We set a very wide range, and in that range, we had an equilibrium. We essentially had the high of the bull move, the initial low of the pullback, a lower high, which was almost a double top, a higher low then formed, and then we had a bull break. So we had this tightening pattern that we were watching in the video from last weekend, and it ended up being a bull break. So 2147 was resistance. The first signal was 2140. We broke both those levels. And the bottom line is we're still maintaining the daily higher low pattern. So anything above 2056 is going to be a higher low right now. And this is healthy consolidation that we saw on Thursday and Friday, closing out the week. So the bull miners still have control of the daily uptrend. Gold still has control of the daily uptrend. And the junior miners, same thing, and a much more convincing close. We've been pointing out how the junior miners have been a laggard to the senior miners, and this week is a move where they're trying to catch up. Look at GDX on the weekly, and it's a solid green candlestick, but only just barely getting over the high of the previous 2 weeks, whereas GDX very clearly is getting over the high of the previous 2 weeks, as well as the high of back in October. And again, the senior miners had already cleared that high of October. So what this week shows me is that the junior miners are playing catch up with the bulls, following through and making their way back to where the senior miners are. So where this price ended, the high of the week for the junior miners, we got above the week of August 6th. So I go and I look and I say, what was the high of the week of August 6th for the senior miners? And it was here at 2109. So again, I can see, not like that, I can see that we are evening out. You know, we're still a little bit ahead of the game on these senior miners, but far less significantly than we were just before this week occurred. So a nice turnaround and picking up the slack for the junior miners, and a very clear trend change with essentially a higher low, almost a double bottom, and then a break of the lower highs. So that's a shift in momentum and a shift in the trend. And again, watching this exponential moving average for a potential cross on the weekly, as it's a little bit behind the gold weekly exponential cross that has already occurred. So a very clear uptrend. Again, here was another tightening pattern that gave a clear bull signal with our high, low of the pullback, double top, build a little base of support, and then a significant bull break, ending the week with a daily inside bar to be watching on Monday. And if you don't know what inside bars are, search on Google or YouTube and find our video on inside bars. So bulls in full control when we do consolidate on the daily time frame. 29.37, anything above that level will be a higher low, keeping the bulls in full control. And as far as the next resistance levels go, after 31.59 on GDXJ, we're going to be looking back at 32.42 as the next level. For GDX, the senior miners here, if we can get above the high of this move, 21.54, we're then going to be looking up at the next level of 21.80. So bottom line is some of these weekly time frames a little bit extended on gold and these miners, but it's all about the daily uptrend. And as long as that holds, then the bulls don't have anything to worry about. Lose the daily uptrend, that's the indication that weekly consolidation is coming, and all of these names are going to be looking for weekly higher lows to form because it's been a bullish month plus for gold and these miners. Oil, weekly bounce underway. Anything on the weekly under 54.54 is just a lower high. So we know the weekly trend is not going to change anytime soon. Right now, we're watching for the possibility this is going to be looking out perhaps another 5 to 6 weeks, but looking at the potential of an inverse head and shoulders pattern. So if on this bounce, if we do not break 54.54 and we set just a lower high, we're then going to look to pull back and form a higher low compared to the low of 42.34. And if we can form that higher low, it would be our right shoulder, and then we would look to break the lower highs and change the weekly trend for the oil bulls to try and get some follow through. So that's what I'm watching on oil, on the weekly for the oil chart. Can the bulls get above that lower high pattern? And if not, can they form the higher low to give us this head and shoulders pattern that is just starting to shape up right now. So again, we zoom into the daily for more detail. We can see that we topped out on the bounce, established a base of support, and that's down at 44.33, and then saw continuation with increasing bull volume Wednesday through Friday. Inside bar on the daily broke bullish Friday, nice little follow through. And again, I cannot stress enough the correlations between the overall market and the S&P 500, or I should say the overall market and oil. But if we compare SPY, this bounce in the market after things were so bleak is being marked by this bounce in oil. They both hit their bottoms on the same day. The bounces started at the same time, and the bounce followed through for oil on Friday. Bounce followed through for the S&P 500. So we're starting to see the talking heads point out the correlation with oil a little bit more, but it's, again, you look back to the past few years, looking back to 2016, when we have dumps, the bottoms are marked. Usually the tops are marked by oil topping out, like it was back in October, and then the bottoms are marked by oil bottoming out. So keep an eye on oil if you're keeping an eye on markets and vice versa. So on any consolidation on the daily for oil, as long as we hold 44.33, it's a higher low, keeping the bulls in control. The most important next resistance levels, 53.24, and then that weekly level of 54.54. And it's all about 54.54 for me over the coming 2 weeks. Again, can we break that resistance level, or do we need to consolidate for that right shoulder to form on an inverse head and shoulders pattern? And we're going to be watching the exponential moving averages here as well. You can see we had a bull cross back in the 70 range where we ran up another 10%. We had the bear cross where we then dropped, almost 50%. And now we're going to watch them level out a little bit here. And we're going to see, can they make a bull cross in January in order to see a more significant weekly bounce play out? And if we're going to see the S&P 500 recover significantly, we're going to have to see the weekly trend change on oil, in my opinion, with that higher low and then continuation move. Natural gas finally starting to see a daily oversold bounce. We can see on the weekly time frame, and I'm looking at NatGas USD, but we can see that the weekly time frame really hasn't started that much of a bounce yet. Volume has consistently dropped off. We have a little bit of a lower wick, but it's not a bullish reversal candlestick. The daily time frame just getting the first green day in a while. We have not seen 2 green days on natural gas since pretty much a month ago. So bulls really want another green day on Monday. I'm starting to build a little bit of a position, and it's a swing position, and it's utilizing the weekly time frame, knowing that a weekly bounce is coming and that a lower high is going to form on this weekly bounce, but just getting ready for that weekly bounce to play out. I personally am choosing to play UNG rather than a 3 times leveraged ETF. Number 1, because I want less risk and less reward on this swing trade. And number 2, I don't want to have to worry about any kind of time decay if I am looking to hold this multiple weeks for this bounce to play out. And if this is our bottom, which it's far too early on the daily chart to say, our bottom is in right now, the S&P 500, I can look at the size of the bounce and say, all right, our temporary bottom is in. Can't do that for natural gas just with a 1-day bounce at this point. But let's just pretend it was. If this were the bottom at 290, I would say a conservative bounce would be a 15% bounce. And so that's UNG seeing a 15% bounce. And of course, the leverage ETF seeing a 45% bounce. But again, it all depends on, how much capital you're putting at risk and how much risk to reward you want on that trade scenario. So I built my first position on, Friday. And I actually made a mistake by letting a really good entry go. And I'll point that out in just a moment. But I'm going to enter 1 position. My game plan is I will enter a total of 3 positions on this move, but I'm not going to add to my position until 2 things happen. Either number 1, we get another leg down on the daily time frame and we drop down into the 280s, the low 280s. Then I would look to potentially add another position. It depends on what the chart looks like when we get there and how fast we would get there. Or a daily trend change indicating that our weekly support level is set, I would add another position on a daily trend change. So if we get more follow through and then a little higher low and higher high, I would look to potentially enter on that trend change. So the bounce is just starting to play out. I was highlighting the need for a 4-hour trend change, and we were also highlighting the hourly equilibrium in the last video that we looked at Thursday night. And we had our high, low, lower high, higher low, lower high, higher low. Very clear bull break. This was great for futures traders. 2 a.m. was clearly the bull signal, and we got a significant amount of follow through. We then had a bearish reaction to the inventory report, and this is the great entry that I had. I bought that weakness on that inventory report. And my reasoning for that was just a bottom fishing play where I wanted to make an entry and I would exit if we broke 2906. So I got a really good entry there and we started to bounce, and the bounce was a little bit slower than made me comfortable. We had the initial long lower wick and then we had a top, and then we started to pull back, and I was not patient enough waiting for the higher low. I wanted to lock in those short-term gains while I had them, very small gains compared to where that bounce ended up going at the end of the day. So that's kind of one of those things where I was like reminding myself, man, zoom out. You're looking for a weekly bounce and you're looking at the 5-minute time frame to dictate, your exit. So that was just a reminder for me to get out of the day trading mindset and look longer term. So I gave up that good entry and then entered later in the afternoon heading towards the close and a worse entry. But again, I'm looking longer term, and that was just a mistake that I will look to correct, as my resolution for the New Year's was zoom out and look for longer term holds, multiple day trades, multiple day swing trades, and potentially multiple weeks, which is what I would be looking here for natural gas. So I'm going to be very patient. Again, building positions. I'm in no rush to go all in on this play because the bounce is very limited at this point. And what I want to see is continuation of a 4-hour shift in momentum. I want to see 4-hour higher lows and higher highs continue. The next key resistance after the top of 3076 is going to be 317.2. And if we break 317.2, there's a lot of space before the next resistance level. That would be a very important break to occur to show, okay, our temporary bottom is in for now. Let's see how much follow through we can get from here. So that's where we stand on everything heading into this coming week. Certainly some decent opportunity in the commodities space. The commodities space was dead for a while in 2017, but we've had gold with some nice shifts. And now, of course, oil, huge volatility on the dump and getting some bounce going. And of course, natural gas, huge breakout, huge dump. And we're going to expect volatility in natural gas to continue. Again, I know the fundamental story for natural gas is all about, less draw than anticipated and temperatures are warm and all that. But I just disregard all that noise because so many times in my trading career, I see the fundamental narrative shift after the chart shifts. So we see a temporary bottom set, we see a shift in momentum, and then the articles start coming out. And we're seeing in the S&P 500 right now where it was all doom and gloom and fear, and then we saw a very bullish Friday, and now over the weekend we're seeing bullish market articles come out. So I fully anticipate that when we see this bounce get going on the daily time frame, we're going to see the shift in the sentiment about the weather and about what's anticipated. But when you get this much volatility in this short a period of time, an equilibrium is absolutely the most likely scenario to be looking for, which is why I am interested in natural gas and buying into the weakness that we have been seeing. So remain protective out there. Things can always drop further than you think they can, and that's certainly something that we want to protect against and limit our risk in these trades, especially when we're going counter the trend right now. But I'm liking the setup. So have a good weekend, and we'll see you soon.